Gold, known to be the ultimate safe haven asset, is suddenly seeing a sharp drop after its record-breaking rally. What is behind the sudden fall, and what should investors do? Let's break it all down. Gold prices have seen a significant decline after touching fresh lifetime highs. Gold futures on the MCX with December expiry have dropped nearly 7% last week after hitting an all-time high of Rs 1.32 lakh per 10 grams. The contracts with February and April expiries have corrected more than 7% each from their respective lifetime highs. Gold ETFs too have mirrored the sharp decline. Nippon India Gold ETF had fallen more than 12% in just 3 sessions from its all-time high to hit a week's low of Rs 95.55 during the week, before seeing some recovery. HDFC Gold ETF, ICICI Prudential Gold ETF, Axis Mutual Fund Gold ETF and Kotak Gold ETF dropped up to 6% during the week after hitting fresh record highs. Despite the sharp fall, these ETFs have delivered a one-year return of more than 50%. So what's behind the recent sharp decline? Analysts say investors may have booked profits at elevated levels after the big rally. There was also caution last week ahead of key US inflation data, which could influence the Federal Reserve's next policy move. Any rate cut by the American Central Bank can have a major impact on gold prices. According to Ross Maxwell, global strategy lead at VT Markets, the long-term fundamentals for gold remain broadly supportive despite near-term cooling. He points out that gold is still up over 50% this year due to factors like a weaker US dollar, strong central bank buying, and expectations of lower interest rates, along with persistent geopolitical tensions. Maxwell added that if inflation comes in softer than expected, it could reinforce bets on rate cuts, potentially reigniting gold's upward momentum. Notably, US inflation data for the month of September did indeed come in softer than expected, with core consumer price index, excluding the often volatile food and energy categories, increasing 0.2% from August, according to Bureau of Labor Statistics data. This was the slowest pace in 3 months and has increased expectations of a rate cut by the US Federal Reserve. Maxwell, however, cautions that a firmer dollar or a rise in real yields could trigger a 5 to 10% short-term correction, especially as gold now trades in that crucial $4,000 to $4,400 per ounce psychological zone. Meanwhile, Jatin Trivedi from LKP Securities says the ongoing US government shutdown and uncertainty around trade negotiations are expected to keep gold sentiment cautious. In the near term, he expects gold prices to remain volatile in the range of Rs 1.18 lakh to 1.25 lakh with a slightly negative bias, at least until there is more clarity on these macro developments. Adding to that, analysts from Angel One anticipate further downside in gold prices in November and December. That is because seasonal demand is tapering off after the festive period. He also notes that investor sentiment has shifted. Traders are now increasing exposure to put options, which suggests they are positioning for continued weakness in the coming months. So what does all of this mean for investors? Experts say there are still opportunities to participate in gold's long-term story. You can invest through digital gold platforms or investment accounts for easy, low-entry access. If you prefer liquidity and cost efficiency, ETFs are a great choice. And for more advanced investors, futures, options, and gold mining equities can offer leveraged exposure, though they come with higher risks. The key takeaway: adopt a disciplined investment approach. Build positions gradually through dollar cost averaging. Keep your portfolio diversified and track US inflation data and Fed policy guidance closely. Because even though prices may cool in the short term, gold's long-term fundamentals remain solid. So, what do you think? Is this dip in gold prices a buying opportunity or a sign of more correction ahead? Let us know in the comment section below. Don't forget to like this video, share it with other investors, and subscribe to our channel for more such market insights.